Growth in South Africa's retail sales slowed to 2.8% year-on-year in March. That was from a revised 3.9% in February. It came as SPAR's first half headline earnings per share up 12% to 3.42 cents, and Hold Sports reported a 9.5% rise in full-year headline earnings per share to 3.90 cents. So joining us now to dissect those overall numbers is John Luce, who's the household and consumer sector strategist at FNB. John, retail sales growth slowing. The way we've been hearing about the issues in the consumer sector, one wonders that for how long, much longer there's going to be growth at all.
Yeah, David, 2.8 down from 3.8% year on year in February, but I like to look at it a little bit more smoothed out and on a quarterly basis, just because these figures are rough from month to month. And there we had a slight improvement from late last year, 2.6% in the fourth quarter growth and up to 3% in the first quarter of this year. Now, I think that slight improvement was possibly an economy just growing a little bit faster after all the strike disruptions of the second half of last year. But having said that, I think now we're settling down probably into a pattern of between 2 and 3%, somewhere in line with what we expect for GDP growth this year, which is about 2.5%, 2.4%. I think, the days of the last few years where real retail sales has exceeded GDP growth by quite a significant margin, I think that's over. Now we're just going to track GDP, whatever that will turn out to be.
Yeah.
That 2.8, is that real growth or is that just nominal growth?
That's real growth, yeah.
It doesn't say too much about how they're coping with, say, satisfying the population as a whole, because we've got a population increase of, say, 2.5 to 3%. It means nothing real at all, and perhaps that just says the size of the challenge facing the retail sector.
But also, John,
sure.
I don't know if you heard our earlier interview with Sajal Singh. He was saying we're looking at GDP growth if the mining sector issues continue as we expect them to, as low as 1%.
I think that's a realistic, what I'd call a downside risk. I mean, our GDP forecast for the year is 2.4, but that is assuming no out of the ordinary strike disruptions. At the moment, I think the last couple of years, with the global economy having stagnated, with our own economy having stagnated to a low growth rate and all the social unrest that heightens in that environment, the reality is that more frequently now in the coming years, you could get major disruptions as a result of strikes or service delivery protests, whatever. And that is a downside risk for GDP. We're not working on that at the moment, but it is a realistic risk.
You raise what I think is an interesting concept here, normalizations, which you put in inverted commas, normalizations after the big 2008-2009 prices and recession shock.
Yes, what we saw with disposable income was that real disposable income exceeded GDP growth by a significant margin around 2010, 2011. A lot of that because off a very low base after the recession, as company performances improve, discretionary reward returns. That dies in recession times, and then afterwards with a bit of a lag comes back and grows very strongly. You also find investment-related income, dividend payments and so on, they slump more extremely than, say, wages in the recession times, and then also come back with a bang. But those normalizations in those levels have probably taken place. Your big sort of shoot up in employment levels after recession, that's probably normalized, and now everything's sort of flattening out, and I think we're going into a prolonged stage where, well, not only will disposable income growth come down more into line with GDP growth, but GDP growth itself is not looking to perform wonderfully.
John, just looking at the various sectors in the retail sector, I noticed that there were two sectors which were mentioned as actually slowing down quite considerably. There was clothing and footwear, and also the other section which included jewelry and sports equipment. Now, it's interesting does that mean that there's a growing awareness in consumers' minds that it's bare essentials only on spending patterns, and they're really going to see a cutback in anything more than that?
Well, actually, when looking at it on a quarterly basis, I mean, the clothing and footwear was actually quite significant growth. That was one of the better ones, which is quite amazing. We always seem to somehow, a lot of that has to do with very low price inflation rates in that sector over the last couple of years, but yes, we always seem to clothe ourselves quite well. Furniture, appliances seem to be dropping, hardware is low, and also food retail sales is starting to come under pressure as well now. So It's broad-based at the moment. Yeah, but it's always interesting, the South African consumer, what they spend on. You would think, I would have thought clothing and footwear would have slumped more, and food would actually grow reasonably, but yeah,
I think also the market doesn't lie, and in a sense, when you see companies reporting results that have come through tough times and grown and are not growing anymore, one thinks of Cashbuild, Ian, which had, I think, a 1% increase last week. We've got Spar today, and it was interesting hearing this morning the comments. Yes, they're growing, but it's not the expectation, not what was expected before. So the companies are now reflecting the kinds of things you're talking about.
Yes, and I think a lot of your replacement and sort of backlogs have been addressed as well, like home maintenance. You know, that surged sometime after the recession. Now it's got back to levels where, okay, we're maintaining homes again on a more significant basis, and so yes, there's no further growth in the sales of hardware, or not much growth anymore like there was a year or two ago. Probably the same you found with new vehicle sales, although that falls outside this. You know, grown very strongly as people replace cars, but now sort of starting to broadly taper.
Well, let's look at one of the companies that, or rather corporate action that we've seen involving companies today. Shareholders of Cipla Medpro South Africa have approved a $500 million buyout offer from India's Cipla. You may remember that was announced some months ago, and there was a lot of wrangling about the price. The deal will result in Cipla Medpro being delisted from the Johannesburg Exchange in September, and Cipla Medpro slightly up on the day. Those shareholders pleased with that, but it's been going for some time. You know?
It has been dragging on, but at least they've announced it. There's a price. There's a total cost, 4.5 billion in rand terms. You said $500 million. It's a big deal by South African standards. So the M&A sector is not dead, that's for sure. And it just may mean that are other foreign investors going to be attracted into our economy? That could be a good sign.